Let me be direct with you from the outset, because what happened on June 9th, 2026 is not getting the coverage it deserves. What we witnessed was not a diplomatic disagreement. It was not a temporary policy shift. What we witnessed was the official termination of the agreement that has underpinned the US dollar's global dominance for the past 52 years. I am looking at the official statement released by the Saudi Ministry of Finance at 1400 hours Riyadh time. What it says is not ambiguous. It is not subject to interpretation. Saudi Arabia announced that effective immediately, it will accept payment for oil exports in any currency, including yuan, euros, yen, and even digital currencies, with the US dollar being just one option among many rather than the required standard. That is not a policy adjustment. That is the end of the petrodollar system as we have known it since 1974. In the next 20 minutes, I am going to walk you through exactly why Saudi Arabia made this decision, why the US Treasury is facing a crisis that could reshape American economic power, and why the market reaction you saw on June 9th is just the beginning of a much larger financial restructuring. This is Daily Brief. Subscribe now if you have not already, because what we are about to cover is being discussed in emergency meetings at the Federal Reserve, the Treasury Department, and every major central bank in the world. Let's start with the history, because you cannot understand the magnitude of this moment without understanding what the petrodollar system actually was. In 1974, following the oil crisis and the collapse of the Bretton Woods system, the United States and Saudi Arabia reached an agreement. Saudi Arabia would sell its oil exclusively in US dollars. In exchange, the United States would provide military protection, weapons sales, and political support for the Saudi regime. This agreement had a profound effect. It meant that every country that wanted to buy oil from Saudi Arabia, the world's largest oil exporter, needed to hold US dollars. That created permanent global demand for dollars, regardless of America's economic fundamentals. It allowed the United States to run enormous trade deficits and federal budget deficits without the currency crises that would destroy other countries. It was, as some economists have described it, the closest thing to a free lunch in international finance. According to the Bank for International Settlements, approximately 80% of global oil transactions were conducted in US dollars as recently as 2020. That translates to roughly $14 to $16 trillion in annual transactions that required dollar reserves. Those reserves were typically held in US Treasury securities, which meant the petrodollar system created guaranteed buyers for American government debt. Subscribe if you are starting to understand why this announcement is not just about oil, it is about the entire architecture of American financial power. Now let's talk about what Saudi Arabia actually did and why the timing reveals a geopolitical calculation that has been years in the making. Announcement number 1, the currency basket framework. And this one matters because it is not a complete abandonment of the dollar, but something potentially more damaging over time. Saudi Arabia's new policy establishes what it calls a diversified settlement system. Oil buyers can now pay in US dollars, Chinese yuan, euros, Japanese yen, British pounds, or a basket of currencies weighted to the buyer's preference. For the first time, Saudi Arabia will also accept payment in digital currencies that meet certain stability criteria, which most analysts interpret as a reference to China's digital yuan. Here is what makes this so significant. Saudi Arabia is not banning dollar transactions. It is making dollars optional. That is arguably worse for US interests because it creates a slow erosion of dollar dominance rather than a dramatic crisis that might trigger a coordinated Western response. Countries can gradually shift their oil purchases to other currencies, and each individual transaction seems small and unremarkable, even as the cumulative effect is massive. The Saudi statement included specific language about promoting multipolarity in global finance and reducing concentration risk in currency reserves. That phrasing is important because it signals that this is not just a Saudi decision. It is coordinated with other major powers, almost certainly China and possibly Russia, India, and other BRICS nations. Within 6 hours of the Saudi announcement, the United Arab Emirates and Kuwait both released statements saying they were reviewing their currency policies for energy exports. That is not coincidence. That is coordinated action. According to currency trading data from the first 24 hours after the announcement, the dollar index fell 2%, the sharpest single-day decline since the 2008 financial crisis. The yuan appreciated 8% against the dollar. Gold prices increased 7% as investors sought safety. The 10-year US Treasury yield jumped 23 basis points as markets began pricing in reduced foreign demand for American government debt. Dr. Sarah Mitchell, chief economist at the Peterson Institute for International Economics, stated in an emergency briefing, and I am quoting her directly, that if even 20% of global oil transactions shift away from dollars over the next 5 years, the United States could face borrowing costs 5 to 5 percentage points higher than current levels. That translates to hundreds of billions of dollars in additional annual interest payments on the national debt. Received. That is announcement number 1. Announcement number 2, China's role in this transformation. This is the part that reveals why this shift was inevitable and why US policymakers should have seen it coming years ago. Saudi Arabia's largest oil customer is not the United States. It is China. In 2025, China imported approximately 76 million barrels per day from Saudi Arabia, accounting for roughly 17% of total Saudi oil exports. The United States imported just 380,000 barrels per day. That is a 6-to-1 ratio. For the past 3 years, China has been negotiating with Saudi Arabia to accept yuan payment for oil. Those negotiations were conducted quietly, away from media attention, often dismissed by Western analysts as unrealistic given the yuan's limited international convertibility. But what those analysts missed was China's systematic construction of the infrastructure necessary to make yuan oil payments viable. In 2024, China established the Shanghai Petroleum and Natural Gas Exchange with contracts denominated in yuan. In early 2025, the People's Bank of China created a currency swap mechanism allowing Saudi Arabia to convert yuan revenues into any major currency without going through dollar markets. In March 2026, just 3 months before the Saudi announcement, China and Saudi Arabia signed what was described at the time as a minor technical agreement on payment systems. That agreement was not minor. It was the legal framework for yuan-denominated oil transactions. Think about the strategic logic from Saudi Arabia's perspective. Your largest customer wants to pay in its own currency. That customer offers to backstop currency conversion risk and provide access to the world's second-largest economy. Meanwhile, your traditional security partner, the United States, has become increasingly unreliable, criticized your human rights record, threatened sanctions over various policy disagreements, and generally made clear that the relationship is transactional rather than based on shared values. Stay with me, because this is where the implications for the US economy shift from theoretical to immediate, and where every American with a retirement account or a mortgage needs to pay attention. The petrodollar system served multiple functions for the US economy. It created demand for dollars, it created demand for Treasury securities, and it allowed the Federal Reserve to export inflation by printing money that other countries had to hold to buy oil. When that system erodes, all 3 of those benefits diminish. The Congressional Budget Office projects that the US federal government will add approximately $3 trillion to the national debt in fiscal year 2026. That debt is financed by selling Treasury securities to investors, many of them foreign central banks that hold dollars because they need them to buy oil. If those central banks need fewer dollars, they buy fewer treasuries, which means interest rates rise to attract other buyers. Morgan Stanley released a research note on June 10th, estimating that a 10% reduction in foreign official holdings of US Treasuries would require the Federal Reserve to either dramatically increase its own Treasury purchases, which means printing money and risking inflation, or allow interest rates to rise by 40 to 60 basis points across the yield curve. Either option is painful. For American consumers and businesses, this means higher borrowing costs. Mortgages, auto loans, credit cards, business loans, all of them priced off Treasury yields. A 50 basis point increase in Treasury yields translates to roughly 70 to 90 basis points higher mortgage rates, which adds hundreds of dollars to monthly payments for home buyers. Received. That is announcement number 2. Announcement number 3, and this is the one that explains why the US response has been so muted and why this crisis reveals a deeper truth about declining American influence. The US Treasury released a statement on June 10th describing the Saudi decision as concerning, but noting that the dollar remains the world's dominant reserve currency. The State Department called for continued dialogue with Saudi partners. The White House press secretary said the administration is monitoring the situation. That is not a robust response. That is barely a response at all. Why? Because the United States has almost no leverage to change Saudi Arabia's decision. The traditional tools of American influence, military protection, weapons sales, diplomatic support, are all less valuable to Saudi Arabia than they were a decade ago. Saudi Arabia has diversified its security relationships, purchasing advanced weapons from China and signing defense cooperation agreements with Russia. The Saudi leadership has concluded, probably correctly, that America's security guarantees are not as essential as they once were. Moreover, any aggressive US response would likely backfire. Sanctions on Saudi Arabia would disrupt global oil markets and harm American consumers. Military threats are absurd in this context. Diplomatic isolation would push Saudi Arabia even closer to China. The United States is discovering that when your influence is based primarily on your ability to offer benefits rather than impose costs, that influence evaporates when others can offer comparable benefits. Now let's talk about what happens next, because this is not a static situation. This is the beginning of a process that will unfold over years and reshape the entire international financial system. China will almost certainly expand yuan-denominated oil purchases rapidly. Other major oil importers, particularly India, will negotiate similar arrangements. Within 18 to 24 months, it is reasonable to expect that 30 to 40% of global oil transactions will be conducted in currencies other than dollars. That is not speculation. That is the logical extension of the infrastructure and agreements already in place. The impact on the dollar's reserve currency status will be gradual but cumulative. Central banks will slowly reduce their dollar holdings from current levels around 59% of global reserves to perhaps 45 to 50% over the next 5 years. Each percentage point of reduction represents roughly $150 to $200 billion flowing out of dollar assets, mostly treasuries. The Federal Reserve will face an impossible choice. It can allow interest rates to rise to whatever level is necessary to attract enough buyers for US government debt. But that would likely trigger a recession and potentially a financial crisis. Or it can print money to buy the treasuries that foreign central banks are selling. But that would risk 1970s-style inflation. There is no pain-free option. This pattern has repeated throughout history. Every dominant currency eventually loses its status, and the mechanism is always the same. Overextension, excessive debt, declining economic fundamentals, and emerging alternatives combine to erode confidence. The British pound sterling was the world's dominant reserve currency from the mid-19th century until the mid-20th century. Britain's economic position eroded gradually through 2 world wars and the loss of colonial holdings. The pound remained dominant longer than Britain's economic fundamentals justified, supported by inertia and lack of alternatives. But when alternatives emerged, primarily the dollar, the transition was swift and painful for Britain. The United States today faces a similar trajectory. Massive federal debt, persistent trade deficits, political dysfunction, and declining industrial capacity have eroded the economic fundamentals that initially justified dollar dominance. The dollar has remained dominant primarily through inertia and lack of alternatives. Saudi Arabia's decision signals that credible alternatives now exist. So where does this leave us? Let me give you 3 scenarios for how this unfolds over the next 5 years. Scenario 1, managed decline. The US and its allies negotiate a gradual, orderly transition to a multipolar currency system. Dollar share of global reserves declines slowly but predictably. US interest rates rise moderately, but not catastrophically. American living standards decline gradually, but social stability is maintained. I assess this as 35% probability because it requires a level of international cooperation and American acceptance of diminished status that may not be politically achievable. Scenario 2, crisis and adjustment. Foreign dollar selling accelerates beyond what markets can absorb. Treasury yields spike. The Federal Reserve is forced to choose between recession and inflation, and chooses inflation. Americans face a period of economic dislocation similar to the 1970s before a new equilibrium is reached at lower living standards. This is 45% probability because it matches historical patterns of reserve currency transitions. Scenario 3, reassertion. The United States implements dramatic economic and foreign policy reforms that restore confidence in the dollar. This could include aggressive deficit reduction, industrial policy to rebuild manufacturing, and foreign policy realignment to reduce military overextension. Dollar dominance stabilizes at a lower but sustainable level. I assess this as 20% probability because the political will for such reforms does not currently exist. I think scenario 2 is most likely. The transition will be disruptive, economically painful, and politically destabilizing. But it will not be an overnight collapse. It will be a grinding process of gradually higher inflation, gradually higher interest rates, and gradually declining American economic power. Here are the questions I want you to take away. First, how quickly will other oil exporters follow Saudi Arabia's lead? Second, what measures, if any, can the US government implement to slow or reverse dollar decline? Third, How should individual investors position their portfolios for a world where the dollar is no longer the undisputed global reserve currency? Tell me in the comments what you think the Federal Reserve does as foreign treasury demand declines. Tell me if you believe the US can implement the reforms necessary to stabilize the dollar, or if decline is now inevitable. We will keep tracking currency markets, treasury yields, and oil trading patterns. That is what Daily Brief does every single day. Subscribe now. Share this with everyone who needs to understand why their savings, their retirement accounts, and their economic future just became significantly more uncertain. Turn on notifications so you do not miss the next update, and we will see you in the next analysis.